Canadian banks just issued their most dramatic economic warning in years. And I'm not talking about some vague forecast that analysts debate. I'm talking about major credit rating agencies downgrading Canada's entire banking sector. I'm talking about warnings of recession, mortgage payment shocks, and financial stress that could rival the 2008 crisis. This is happening right now, December 2025. Multiple major institutions are sounding alarms simultaneously, and most Canadians have absolutely no idea how serious this is about to get. I'm going to break down exactly what's happening here, the timeline, the numbers, the warnings, because this isn't just about banks protecting their balance sheets. This is about your mortgage payment potentially jumping by hundreds of dollars per month. This is about your job security if you work in trade-sensitive industries. This is about Canada's economic future. But first, if you want to stay ahead of what's actually happening in Canada's economy without the corporate media spin, make sure you're subscribed to our channel Canada 24 Hub. Hit that subscribe button right now. Check if you're actually subscribed because your subscription helps us keep doing this kind of deep dive reporting. All right, let's get into what just happened. December 5th, 2025. Fitch Ratings, one of the world's three major credit rating agencies alongside Moody's and S&P, maintained its deteriorating outlook for Canadian banks. Not neutral, not stable, deteriorating. Maria Gabriela Corey, Senior Director of Banks for North America at Fitch, went on BNN Bloomberg December 17th. Here's what she said about the sector outlook. The sector outlook reflects the business environment for banks. It doesn't speak to the bank's creditworthiness themselves, but rather what it's like to operate in that environment. While banks have proven very resilient this year, we still think the headwinds leave some room for potential deterioration in the coming year. Translation, the banks themselves are solid, but the economic environment they're operating in is getting worse, and that means problems are coming. Fitch's biggest concern, trade risk, USMCA renegotiations starting mid-2026, elevated household leverage, mortgage renewals, all of it hitting simultaneously. Here's the number that should terrify you. 60% of all outstanding mortgages in Canada are set to renew in 2025 or 2026. That's roughly 60% of Canada's $1.7 trillion mortgage market, and approximately 60% of those renewals, about 40% of all outstanding mortgages, will renew at higher interest rates. Do the math. That's hundreds of thousands of Canadian households facing payment shocks in the next 12 months. Bank of Canada data from July 2025 shows mortgage holders with 5-year fixed-rate contracts renewing in 2025 or 2026 could face average payment increases of 15% to 20% compared with December 2024 payments. For many households, that's $400 more per month. Every single month, RBC, Canada's largest bank, warned in September 2024 that it expects loan losses in its retail portfolio to continue rising beyond 2025 as mortgages come up for renewal. Chief Risk Officer Graham Hepworth was explicit. Yes, we've had some rate cuts and those have been beneficial, but that doesn't mitigate rates as a headwind for many of these consumers when they go to reprice for mortgages. Yes, it's maybe not as acute in terms of the payment shock as they were facing when we saw rates where they were last quarter or 2 quarters ago, but it still is a payment shock that many of these consumers will face. Bank of Canada held rates at 2.25% in December 2025. They've signaled the policy rate is about right. Translation, don't expect significant rate cuts to save you from mortgage renewal pain. Now let's talk about the recession warnings. Because multiple major banks are explicitly forecasting negative GDP growth. May 2025. TD Bank Chief Economist Beata Caranci warned Canada will enter a recession in 2025. She forecast negative GDP growth in the second and third quarters. She predicted approximately 100,000 job losses by Q3. Her forecast for Canada's real GDP, 0.8% for 2025, just north of 1% for 2026. These are not great numbers. Here's what Caranci said about the middle of the year. We think the middle of the year, the second and third quarters, are going to be deeper contractions than we initially anticipated, based on what we're seeing in terms of private sector job losses, the housing market not reacting to interest rates, consumers being cautious and sentiment being down. This is not a good combination. Bloomberg News surveyed 34 economists in May 2025. Majority conclusion: Canada was already in the early stages of recession. They pointed to rising unemployment and a slowing housing market, but here's where it gets worse. Bank of Canada's May 2025 Financial Stability Report presented stress test scenarios conducted with the International Monetary Fund. The most severe scenario modeled a long-lasting global trade war. The results? Sharp contraction in real GDP of approximately 5%. Unemployment rate spiking beyond 9%. Severe recession lasting 7 quarters, longer than previous historical episodes including the 2008 financial crisis. Mortgage arrears in that scenario could rise to levels comparable with or higher than 2008 to 9. Credit card losses would spike. Business loans, including commercial real estate, would suffer significant losses. Under that stress scenario, capital at large Canadian banks would fall sufficiently to breach the domestic stability buffer, but remain above regulatory minimums. Banks would survive, but credit losses would be massive. Now let's talk about what's actually happening on the ground right now. November 2025, Bank of Canada survey of business and financial leaders. The results should alarm you. Most respondents believe Canada is at risk of entering a recession within the next 6 months. Nearly 90% said Canada's economy is churning along below its true potential. Only 10% said GDP is right where it should be. Fitch Ratings forecast for Canada. Real GDP growth of 1.6% in 2025, sliding to 1.1% in 2026, picking up slightly to 1.5% in 2027. Consumer spending growth will slow to 0.9% as real wage gains remain lackluster amid significant labor market slack. Reduced immigration will weigh on population growth, aggregate consumption, and housing demand. All the tailwinds that kept Canada's economy afloat despite per capita recession are disappearing. Here's what most people don't understand. Canada's per capita GDP has been declining for 6 consecutive quarters as of the third quarter of 2024. Real per-person output down, unemployment rising, but total GDP kept growing because population was surging. Canada added 2.1 million additional consumers since mid-2022. Strong population growth masked a recession-like economic backdrop. Without higher population boosting demand, the Canadian economy almost certainly would have contracted outright over the last 2 years. Per capita household spending is 2.6% below post-pandemic peak and down 2% from pre-pandemic 2019 levels. Per capita GDP has declined to 3.1% below 2019 levels. The unemployment rate is up 1.6 percentage points from post-pandemic lows. And since the 1970s, Canada has never had an increase in unemployment of that size without the economy going through a recession. About half the increase in unemployment from post-pandemic lows has come from layoffs, which are up 20% from a year ago. Real job losses, not just slower hiring. Actual pink slips. Now let's talk about the mortgage delinquency situation, because early cracks are appearing. CIBC reported mortgage delinquency rate rising to 36 basis points in Q3 2025. BMO said impaired loan provisions remain elevated at 45 basis points. RBC pointed to rising pressure in Windsor where auto sector slowdown is straining household budgets. Scotiabank noted variable rate mortgage delinquencies appear to be leveling off, but fixed-rate arrears are now trending higher. Bank of Canada's May 2025 Financial Stability Report noted that arrears rates on credit cards and auto loans have risen for households without a mortgage. After falling to historically low levels during the pandemic, these arrears rates are now back above historical levels. For households with a mortgage, rates of arrears on consumer credit products have also risen over the past 12 months but remain below historical averages. But that's about to change. Fitch forecasts mortgage arrears will increase slightly to a range of 0.25% to 0.3% in 2026, up from 0.2% in 2025. Toronto will see its highest delinquency level since 2012. Medium-sized banks, which tend to focus on mortgage lending to higher-risk borrowers and business lending concentrated in specific industries or regions, have seen a more noticeable rise in mortgage impairments compared to large banks. Here's what's particularly concerning. About 12% of fixed-payment variable-rate mortgages are in negative amortization. That means payments fall short of covering interest. Loan balances are growing instead of shrinking. Some borrowers will need to extend amortization by 5 years just to eliminate payment increases. Others will extract equity from homes through HELOCs as a short-term solution to make payments. These are survival strategies, not sustainable financial management. The housing market isn't responding to rate cuts. Despite the Bank of Canada cutting interest rates by 100 basis points through 2024, home sales plummeted 20% from November 2024. Lack of confidence, job uncertainty, tariff-related fears, immigration slowdown decreasing demand. oversupply in Ontario's condo market, and here's the kicker. The housing market was historically Canada's key economic driver. A surge in home sales typically leads to increased spending on furnishings, renovations, retail. Creates a ripple effect across the economy. In 2025, that engine is stalling. Now let's talk about the trade war impact, because this is the underlying driver of everything. Fitch warned that a prolonged trade impasse would likely dampen investment and intensify cyclical pressures in exposed sectors. A material increase in tariffs would elevate asset quality risks, particularly for corporates with significant U.S. export exposure. Loans to households or businesses in trade-sensitive industries or regions represent around 15% of assets at Canadian banks. If those sectors collapse, credit defaults spike. USMCA renegotiations start July 2026. Right now, about 90% of Canadian exports are protected under USMCA. But that protection expires. And if negotiations fail, effective tariff rates could spike to 25% or higher. Stellantis production cuts in Ontario. GM cutting 750 jobs at Oshawa. Honda suspending $15 billion EV project in Alliston. These are real job losses happening right now in Canada's manufacturing heartland. Trade war uncertainty is already weighing on consumer and business sentiment. Bank of Canada's April 2025 Monetary Policy Report presented two scenarios. Scenario 1. Most new tariffs get negotiated away. Scenario 2. Long-lasting global trade war with large and permanent tariffs brings severe economic consequences, including a year-long recession. We're still waiting to see which scenario unfolds, but the longer uncertainty persists, the more damage accumulates. And here's what really matters for ordinary Canadians. Fitch expects impaired loans and net write-offs to rise in 2026. Credit loss provisions will remain elevated for tariff risk. Loan growth will soften. Net interest margins will come under pressure in the second half of 2026. Banks will tighten lending standards to protect their capital ratios. That means it gets harder to get a mortgage, harder to get a business loan, harder to access credit when you need it. Weaker household finances and slowing immigration represent headwinds. Elevated household leverage and affordability constraints, especially for renters and mortgaged homeowners. Savings rates for both groups turned negative this year. Negative. Canadians are spending more than they earn just to maintain current living standards. Here's the bottom line. Fitch Ratings has a deteriorating outlook for Canadian banks heading into 2026. Major banks are warning of rising credit losses. Bank of Canada stress tests show potential for 5% GDP contraction and 9% unemployment in severe trade war scenario. 60% of mortgages renewing in 2025 to 2026, with many facing 15 to 20% payment increases. Recession warnings from TD Bank, BMO, National Bank, Deloitte. Unemployment has risen 1.6 percentage points, a size that historically only happens in recessions. Per capita GDP has declined for 6 consecutive quarters. Housing market unresponsive to rate cuts. Trade war uncertainty weighing on business investment and consumer confidence. Mortgage delinquencies rising, especially in trade-exposed regions. This isn't hypothetical. This is happening right now. The warnings are coming from the most credible sources in Canadian finance. The timeline is immediate. 2026 is months away. Make sure you're subscribed to this channel because we're going to be covering every development in this economic situation as it unfolds. We're going to analyze every Bank of Canada decision, every employment report, every bank earnings call, every warning from financial institutions, because this is the kind of story that could fundamentally impact millions of Canadian households. This is the kind of story where you need someone to cut through the noise and explain what's actually happening and what it means for your financial future. That's exactly what we do here. That's why you need to be subscribed. That's why you need to share this video with everyone you know. The warnings are real, the timeline is immediate, and Canadian households need to be prepared for what's coming. This story is far from over. Stay tuned.